Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Bill Nixon of Maven Capital Partners to talk about the Maven VCTs. Hello Bill, welcome back to the studio. So we're here to talk about the Maven VCTs. For those who aren't familiar, what are they, what makes them different, and why should investors consider them?
Well, hello, Jonathan. Good to see you again. So the Maven VCTs are long-established VCTs, generalist VCTs, which have a focus mainly on private equity, but have a small exposure to AIM. Our objective is capital preservation and dividends. And on the back of some very strong recent exit activity in the last few months, our new offers have increased their target dividend to 6%. So the VCTs are very focused on income as well as looking after investors' capital.
And Bill, for those who aren't familiar, Maven Capital Partners, who are Maven Capital Partners and what's your role there?
So Maven is a fund management business with a specialism in VCTs, which was set up in 2009 by myself and senior colleagues. We came out of a listed Scottish fund management business. We've now been in business for 15 years. And in 2021, we were acquired by Mattioli Woods PLC, which is now a private company following a recent take private. My role there is I'm the managing partner and also the VCT fund manager, and I've looked after the VCTs since 2001. So I've been in this sector for quite a long time now.
And turning back to the VCTs, what sort of companies do you back? You mentioned you're a generalist investor, but any particular sectors or?
So we tend to avoid, first of all, the consumer sector. We're not huge fans of consumer, which can move in and out of fashion at times. Sectors we very much like sectors such as software, which is a big part of our portfolio. We like cybersecurity, businesses with very sticky, predictable earnings. That's the type of companies we seek out. And we're fortunate enough because we are well diversified regionally. We think some of the best deals are outside London. We see a large number of prospective new investments every year.
And sort of non-cyclical, I guess, is the key as well, isn't it? I think that.
Yeah, that's a very good way to describe it, non-cyclical. I think we're focused on sectors that, frankly, are not going to go away. And we're also focused in sectors where we can always see the end buyer or a pool of end buyers.
So can you give us some recent examples of investments you've made in the VCTs?
So it's actually been quite an interesting year for new investments. We've invested in some new sectors for the first time. Connected Data is a business which, using machine learning and AI, helps debt management businesses streamline their processes. McKenzie Intelligence is a business which is focused on helping the insurance sector using geospatial mapping. It helps those companies with pricing and risk. And lastly, a business in Northern Ireland, Sensoteq. Sensoteq manufactures components that helps monitor condition, temperature, performance, and a range of different industrial applications.
So how do you find these deals? And then, perhaps more importantly, how do you win them? And is there anything about Maven that helps you to win some of these deals?
Well, I think for us, I've said to you before, having a really strong regional presence is important. I think we're in cities such as Glasgow, Edinburgh, Newcastle, Manchester. Manchester, very, very active sector. We're in Reading, which has also been a very strong region for us, as well as London and Bristol. So we see a large number of introductions each year from the corporate finance community. We also have a number of regional funds that we manage for the British Business Bank, and that also helps provide a number of feeder type companies, companies that we can see perform and then invest later at Series A or Series B when the business is proven. We've seen the team, do what they've said they'll do, and then the VCTs can invest at a later stage.
So Bill, turning to the portfolio and perhaps some of the more established holdings, any particular highlights there? Any examples you can share?
Well, there's a number of our companies are doing fairly well in the market, but I'd probably pick out three. One I've mentioned before, Rockar, which is an automotive software business, which we backed when it was significantly pre-profit. That business is now making more than $2 million a year and works with a number of global automotive manufacturers. Summize, which is a legal software business, uses AI to help reduce human intervention in legal contract. That's growing very strongly, doubling its sales every year. And an old economy business, HCS, which manufactures equipment for the global oil and gas sector, unfashionable sector, but that business has a very large addressable market and has now grown its earnings to over 6 million a year. So a real mix of companies, but an example of how certain companies in the portfolio are doing very well.
And to what extent do you get involved in some of these companies? Are you just finding decent management teams and letting them run their businesses, or do you get involved?
Well, it depends how well they perform, to be honest, Jonathan. Generally, we are semi-hands-on to really hands-on, I think, depending on how a business performs or how it needs shaped. We'll always appoint a chairman, which is normally a sector expert. One of our team will tend to join the board. And, we'll attend regular meetings, we'll have regular presentations from the company. So we can be hands-off if a business is doing very well, but if it needs support and intervention, we will do more.
Turning to the portfolio and exits, I guess across the industry, it's been quite a quiet time for exits. Not the case for Maven. You've been very busy this year, Bill. Perhaps you could tell us a little bit more about your exits.
Well, we've had an exceptional year for exits, Jonathan. There's almost an embarrassment of riches this year. We sold a business called Quorum Cybersecurity, where we had previously exited to a private equity buyer, but we crucially, and I'll talk about that more later, we retained some stub equity, and we had a secondary exit to a US private equity firm called Charles Bank. And that investment returned over 8 times money. We had another very good exit, a business called Mirrorweb, which we sold. That's a web archiving business, which we sold to a US private equity firm called Mainsail. That gave us 4.5 times money. But again, we retained equity in that, so we continue to have a share in the upside of that business. And the largest other exit, and we've had a few other smaller ones, but the largest other exit is a business called Novatus, which is a RegTech software business, which again we sold to a US private equity firm for 4.5 times money return. And again, we have continuing economics and an equity share in that business going forward.
So, Bill, what is it about 2024 that saw so many exits for the portfolio?
Well, it's been a huge contrast, Jonathan, between 2023 and 24. 23 was our quietest year for exits for some time. And the exits we saw, the exit opportunities we saw were much more opportunistic, where either US buyers were out the market or pricing was down. 2024 has come roaring back, and we've seen preemptive offers for our better technology assets, mainly from the US. And I would say what is interesting is US buyers will pay a US price. Generally, the kind of what we call the delta, the difference between what a US buyer will pay and what a European buyer will pay is significant. Now, with that comes some challenges. US buyers could be more challenging to deal with in terms of legal contract, but they will generally pay a premium price.
So, Bill, turning to risks, obviously it's fairly risky investing at an early stage. How risky would you say your VCTs are? And is there anything you can do, perhaps with deal structuring or how you manage the portfolio that help to manage the risks?
Well, there's really 2 elements to risk, Jonathan. First of all, there's portfolio theory. And we believe in building large and very diversified, both by number and sector. And secondly, there's risk at investee company level. And how we mitigate or ameliorate risk is we tend to structure all our investments, certainly all our private company investments, with a downside preference. So in practice, even if a company is sold for less than the target value, our investors' capital is out first. And even on a relatively low exit valuation, we can still make a positive return.
So finally, to sum up, Bill, for those that want to back a VCT this year, why should they back the Maven VCTs?
Well, we've been doing this for a long time. I've been doing this for a long time. Our VCTs, some of them have more than 100 companies. We're incredibly diversified. We invest in a number of attractive sectors, as I said, software, healthcare, cybersecurity. These are not sectors that are going away anytime soon. We've proven that we can deliver exits, high value exits, and we've increased our dividend target. So I think that's a pretty compelling combination that makes our VCTs attractive for investors.
Very good. Bill Nixon of Maven Capital Partners, thank you very much.
Thank you, Jonathan.
If you're watching on YouTube, please press like and subscribe to the channel for more.